When I talk to a member, I really talk about member losing value rather than losing money. And if we think of it like their own home, for example, we know that their home fluctuates in value often, but they don't lose money unless they sell it. So what is happening in markets at the moment is being driven by a certain amount of fear that the coronavirus will spread. We don't know how long it will last or how extensive it will be. It is having an impact on businesses and economies around the world, and part of that fear is that we don't know how long it will last. A great question. As an advisor, as an investor, I would say that these times in markets actually provide opportunities for investors. We're actually buying assets at a very low price.
Generally, you are going to find yourself better off by continuing to put in your voluntary contributions into super, especially if it's via salary sacrifice or making tax-deductible contributions. The reason being, there's twofold. The reason being, one, the tax savings that you'll generally be obtaining by salary sacrificing or making a tax-deductible contribution will generally outweigh the losses incurred in the fund going backwards. And secondly, by continually investing along the way, you will be buying assets at lower prices as the prices drop, which means that when the markets do recover, you'll get a bit more bang for your buck.
Cbus provide 5 what we call pre-mixed investment options, ranging from high growth down the growth spectrum to cash. High growth, a 90-10 split approximately, 90% growth assets, shares, property, 10% cash, ranging all the way down to cash which has no growth assets at all, therefore isn't impacted by the markets, but very low return, but no volatility or little volatility.
What we generally find though, unfortunately, is a lot of people will generally move their let's say their growth option to cash, usually after a lot of the falls have already occurred. So they're locking in those losses. Then what we also find is that once the markets start to rebound, we generally find that our members take a while before they get comfortable with the markets again, so they don't move back to growth straight away, therefore missing out on the rebound or a significant amount of the rebound. So quite often, by adopting that practice, you can be chasing your tail. I generally find the better thing for most people is just to ride through these periods of volatility and come out the other side.
As an advisor, what we would talk to members about is the sleep test. So if they're invested in an option at the moment that is causing them a lot of concern and anxiety, moving to cash is an option. All I would say to them is consider the consequences of doing that and how that asset class will behave over time.
I think you'll find with the current markets, all superannuation funds are going to be impacted by these falls in the markets. So it's important to know that whether you're in another super fund or Cbus, you're going to be feeling the impact.
It is an option if you want control over the investments. However, you're invested in exactly the same assets within a self-managed super fund. There are a few key differences. You will be able to make the investment decisions, but with that comes responsibility. You will need to make the decisions. You can invest in cash, but you can do that within Cbus also. You can invest in property. You can also do that through Cbus. It carries a lot of responsibility and a lot of cost. You really need to do your homework very well to ensure that it's a fund that suits you and that you're prepared to take on the added responsibility of running the fund. So cash is a stable asset. Its value doesn't change very much. The only time its value changes is when it earns interest. And as we know, interest rates at the moment are very low, so it's not earning a lot in the way of interest. But it provides stability within a portfolio. So if stability of capital is your main goal, then moving to cash is certainly an option for investors.
You can decide to switch whenever you like, and it doesn't cost you anything at all to do so. We have had members that are trying to protect their super value, and they have made that switch, and then they will form their own view as to when they will try and switch back again. If they do that process, it can take up to 48 hours for that switch to take effect. So if you go in online and do that switch today as an example, it will show that it is a pending switch, and that value might not really be reflected for another 48 hours.
There's always an opportunity to move money back into the market from cash. The question there is, how do we time that, and when do we do that? So if a member has chosen to move to cash, the next big decision that they need to make is, when do I re-enter the market? You know, what is the right time? Nobody knows that. Nobody rings a bell at the top of the market. Nobody rings a bell at the bottom of a market. So once again, it comes back to comfort level.
If you are invested in our SMSF option, or you have your funds in one of our superannuation income streams, it's important for you to understand exactly which investment option you're in. Now, like most of our members who may not have elected one of the specific investment options, you might just be in our default option, which is called a conservative growth option. If you are seeing the value of your superannuation income stream going south or backwards at the moment, it is because of the fact that part of that investment does have exposure to growth assets.
Very good question, and particularly relevant for me also, because I'm approaching retirement and I'm concerned about what's happening in the marketplace. However, what I do know, I don't know what's going to happen in the future, but I can draw on 30 years of advising, so I know that in the past, that when we've had a very sharp decline in markets, as we have experienced this time around, we usually experience a very sharp rebound as well. There is always the option, if you feel that you're too aggressively invested and would like to shore up your position and create a bit more certainty about moving all or some of your capital into less growth-oriented assets. So it might mean moving from growth to conservative growth, or from conservative growth to conservative, or from growth down to cash, to ride out the market volatility. Once again, I'd really encourage you to speak to our advice team.
I would imagine in the event of claiming for a TPD at the moment, you would still proceed with your claim. What you may want to consider, if that claim is granted and the money is paid into your super fund, you then may want to have a look at when is an appropriate time to access some of that money. So if you do possibly have other money outside of superannuation, it may be an opportune time to use some of that before drawing on your super.